They're the only stores open. They are deemed essential. Everybody seems to be doing home improvement projects. The momentum is likely there, but what do you expect from the guidance?
Yeah, so that's a good question, Brian. Good morning, by the way. We're hearing outstanding numbers for both Home Depot and Lowe's, and to your point, people are doing a lot of projects in their house, and so we actually could see numbers that are historical in a lot of ways for both names. We actually have comps up 5%. We think that they're going to reasonably beat those numbers, and we're above the street. In terms of guidance, it's going to be really hard for either company. Home Depot starting, as you say, in a couple of minutes. It's going to be really hard for them to keep guidance for the full year. Most retailers are pulling their guidance, and it's just very difficult to have any visibility in this marketplace. And so we think it would be very reasonable if Home Depot just pulled their full year guidance as well. The biggest question here is the unemployment rate and the lasting implications of that unemployment rate if it stays elevated for an extended period of time. We as a firm actually have Home Depot and Lowe's actually comping negative, slightly negative next year in 2021, simply because of the strength this year, difficult comparison, and unemployment is expected to remain elevated in 2021.
So if they pull guidance, Matt, is that a reason to dump the stock if you own it or avoid it if you don't?
Now, I don't think it's a reason to dump the stock. In fact, our checks so far indicate that both names are enjoying maybe even better comp store sales in the second quarter to date as they did in the first quarter, right? So right now, the trend looks like it's actually getting better. The problem, again, is the back half of this year and going into 2021, because we really don't know the economic damage of the COVID shutdowns and what that can actually mean to big ticket purchases like kitchen remodels and things like that. So we think it's probably in their best interest to not maintain guidance. Look, their peers are pulling guidance for the full year. Some names that actually have visibility, like Nike, who actually had a China business and knows what the recovery path looks like, they've pulled guidance. So we think it's reasonable for them, but we don't necessarily think that's a bad thing because trends are getting better right now.
All right, what is among your coverage universe, Matt, what's your best bet right now for your clients?
Yeah, so I have to say Target, and they're going to report on Wednesday. And the way that I would frame this is exactly how you framed this, which I'm going to say earlier today in the program. You said today's big number is 30%. 30% number of decline of stores of JCPenney. That's where Target's been getting their market share from and their amazing results for the last couple of years. And now it's going to accelerate because JCPenney is going to close stores. You talked earlier in the show about Tier 1 closing stores. That's where that consumer is going to shop. So right now, Target's doing extremely well on comp store sales, but they could actually do even better going into next year simply because of consolidation and market share gains.